Hello, I'm David Chaston with 90 at 9, brought to you by interest.co.nz. This is where you get everything you need to know in 90 seconds at 9 o'clock. With news, the US Fed is staying the course of bringing interest rates back up to normal levels. In Jackson Hole, a key speech by the US Fed chairman is marking him out as more data-driven than economics-driven. He is saying gradual interest rate hikes are the best way to protect the American economic recovery. And he said more rate hikes are likely over and above the two already penciled in for later in 2018. He also said he sees few signs of overheating. This was a direct pushback against the comments of the US president, and equity markets liked it, although the bond markets not so much. In weekend data releases, American durable goods orders fell 1.7% in July from June, and a much bigger fall than markets were expecting. But they were up 8.6% above the same month a year ago. In Washington, trade talks between the US and China failed to produce any visible signs of progress, reducing the prospects of a deal soon. Meanwhile, in China, authorities are trying to stop the yuan falling too fast so as to curb any prospect of capital flight. China is also worried about the rise of Scott Morrison as the Prime Minister of Australia, fingering him as an anti-Chinese influence. One of Morrison's recent moves was to block Chinese firm Huawei from constructing their G5 network, and Canada may also be considering doing the same. More progress is being made on the NAFTA front, with the US reportedly compromising with Mexico on an important sunset clause issue. Expectations are that US-Mexico talks will be completed in a few days, and then Canada will rejoin to resolve its issues. Observers now expect a formal completion sometime in September. Mexican GDP, however, fell in the June quarter, also by more than markets were expecting. It was down 0.2% from the first quarter, but up 2.6% from the same quarter a year ago. And overall global trade volumes were flat in the 3 months through to June, ending 2 years of steady growth. Among the causes were slumping Asian semiconductor demand and fallout from the US-China trade war. In the international marine insurance market, insurers are moving to raise premiums sharply. That move will impact sea freight rates to and from New Zealand. US Treasury 10-year yield is at 2.82%, but their US Treasury 2-year is up firmly, and that has put their 2-10 curve under 20 basis points for the first time since 2007. In fact, it's under 19 basis points. Given as it was 26 basis points at the start of the week, that is a fast, sharp move and not a welcome one. We have more on this shift in a separate story on the website. The Aussie government 10-year is at 2.54%, that's unchanged, and the Chinese government 10-year is at 3.64%, that's down 2 basis points. New Zealand government 10-year is at 2.60%, unchanged. Gold has had a good move up, this time by $20 from yesterday, and that is now at $1,205 an ounce in New York. US oil prices are starting the week firmly higher, now just over $68.50 a barrel, while the Brent benchmark is well over $75.50 a barrel. The US rig count dropped sharply off its recent high. And the Kiwi dollar is also a little firmer at 66.8 US cents. On the cross rates, we're now at 91.2 Aussie cents and 57.4 Euro cents. That puts the TWI at 70.5 and comfortably above its recent 3-year lows. I'm David Chaston. That was 90 at 9, brought to you by interest.co.nz.